Good morning, everybody, and welcome to yet another IFRS webinar that we're presenting to this morning. This morning's webinar will be done by myself, Mark Steenkamp, who you should be familiar with. I've done a few of these before, as well as I'll be joined by Edwin this morning. Both of us are directors at RSM South Africa. And what we'll be covering this morning is really, we're firstly going to look at where we are in this current financial time, in the uncertainties that we're facing at the moment. We'll go through those during the course of the webinar, and just how we report on those, and how we communicate those to our stakeholders. So firstly, we're going to go through understanding our current economic environment and where we are. And then we're going to be looking at and obviously evaluating those and understanding those, and what the causes of these uncertainties are. And then we're also going to look at what the impact are. There are direct impacts and there are indirect impacts because of these uncertainties. And we're going to be looking at those. And then we'll be moving on to obviously the financial reporting part of those, and what the considerations are, and whether, and under that umbrella, we'll be looking at the appropriate basis of reporting, the relevant measurements and recognition concerns that there might be, and also obviously a big one, and I think probably one of the most important ones, is the disclosures in the financial statements to be able to communicate these uncertainties. So in that, the beginning of the first section of the webinar will be handled by Edwin, and I'll then just hand over to Edwin. Thank you very much.
Thank you, Mike, and good morning to everyone. I'll just start by exploring the South African environment, specifically focusing on the current experiences that entities as well as individuals are facing. The diverse macroeconomic and geopolitical circumstances has given rise to an unstable and unpredictable atmosphere, resulting in heightened challenges for businesses in their decision-making, and more importantly, in the accounting and financial reporting processes. And these challenges is evidenced by various circumstances that the entities as well as individuals are currently facing. And we have listed some of the circumstances that we have noted in the South African environment. And the first one being the capital raising challenges that entities are facing. Currently, what we have noted is that there is a high cost of capital, as well as stringent credit risk assessment that is making it difficult for new businesses as well as existing businesses to access capital in order to improve the business circumstances in this current environment. And also what we have also noted is that when there is amounts that might have been extended, those comes with onerous covenant conditions, and some of them are difficult to meet in the current circumstances. We have also heard that there are various layoffs that are being announced, and these have got a challenge or an impact of increasing the unemployment rate, which in turn will also have a direct effect on the businesses, as this will also change consumer preferences and spending patterns. There has been some extensive restructuring efforts that entities are now pursuing. And recently, we also had the one relating to Nissan, which was communicated this week, where they are also cutting down on the number of employees, as well as reducing the non-profit making operations. And most importantly, there is a lot of public unrest as well as load shedding. And this is also having a direct impact in terms of the supply chain and also the general service offering for entities, which affects the profitability as well as increase the cost of production, as entities will now be exploring alternative energy sources, and some of it comes at a cost. And considering that currently the fuel price is continuously increasing, then it means that bottom line will be affected. With the current changes, although the interest rate increases has been on hold, what we have also noted is that with this higher inflation that is currently being experienced, the Reserve Bank continuously increases the interest rate in order to curb the higher inflation. And with that process, there is an anticipation that these interests will continue to increase, considering the increases that are coming based on the fuel increase, as well as the layoffs that are also happening in the industry. There has also been a growing concern in the real estate industry, and not only on the corporate businesses, but also affecting residential properties. What we have noted is that currently with the new way of working, where employees are now able to work remotely, the need for office space is reducing, meaning to say that entities are now focusing more on reduced office space, considering that there are alternative technologies that will allow employees to continue delivering at the same rate, as well as on the residential, employees can now reside anywhere else in the world and also be in a position to service. And that is also affecting the real industry in terms of low occupation rates. We have also seen in the recent past that there is also a constricted labor market where foreign markets are also tapping into our current labor market. And this is mainly affecting the skilled labor, which is also affecting the entities in terms of the service offering. There is also foreign currency exposures or fluctuations that we are currently experiencing, and that mainly also affect the entities that trade in Forex as the cost will continuously increase. And for those that have got foreign borrowings, the amounts of repayment will also increase, which affects entities. The war in various regions, as well as challenges at our port of entries, have also resulted in impediments in the supply chain, which is also affecting various entities and industries. And of late, we have also heard about the exposure to the climate-related risks, where there are floods in certain areas, as well as regions in other countries as well. So it is important that preparers and users of financial statements have a better understanding of how these circumstances affect the entity's financial reporting process, as it will have a direct impact. And how does the entity address this? There is an assessment that is called a Pestel Analysis. With this, it looks at the various macroeconomic trends in the surrounding industry and assess how this affects the business. And with all these factors, some of them have got a direct impact on the financial information that entities are preparing, and indirect impact on some elements. So it's important that entities understand these factors and prepare proper risk assessment. So with the factors, we'll start with the geopolitical instability. What we have also noted is that in certain areas, especially at international stage, there is wars in various regions. And with this, this might have a direct effect on the supply chain, as well as cost of capital. And with these political instabilities, it also focuses on the current policies as well as laws and how they affect the entity. And regularly, there has been some various changes in the laws as well as the policies that has a direct effect on the entity's operations. The second factor, it's the economic factors. And under this, we'll also be highlighting that the issues of interest rate, foreign currency, the issues of inflation, And some of these have got a direct impact on the entity. And so what is important is to understand how each of these elements affect the elements on the financial statements. We also have got social factors, like what I was highlighting. This affects the lifestyle as well as career views. With these social factors, it's also influenced by the technology developments. What we have seen is that people are now preferring remote working, and also some career views where new careers are now emerging. And with all this, it feeds into those technology developments, which focuses mainly on the innovation and automation. There is also regulatory changes. With this, there are various changes that are happening in terms of the legislation. And some of these have affects the health and safety, data protection, which includes the POPI Act. And also, lastly, there is the environment, which just mainly focuses on the climate change. So it is difficult for entities to assess the links between these factors. So what is important for entities to do is to use that Pestel analysis, which focuses on those elements, and develop or revisit the risk assessment process. So, and as part of that, the risk assessment, you also need to understand the processes that the entity has, the controls that are in place to ensure that the accounting and reporting reflects the changing in the macroeconomic as well as geopolitical factors. So with this, what we are recommending is that you need to look at each and every factor. If it's an economic factor, then you assess the risks that these are posing on the entities, identify the financial statements elements that are directly affected. If for interest, the example would be those amounts that are subject to interest rate fluctuations, interest rate risks, and also the inflation, which focuses on various expenses as well as be it capital or revenue expenditure, as well as other elements. And once we have identified those direct and indirect effects, then the entity will need to consider developing various models that will assist in assessing the impact of these have on the figures that have been reported. And where necessary, you also need to consider the forward-looking information, and that should be inbuilt in the model to assist with the preparation of financial statements. And with that, we go to the next slide, which just indicates why is this important to the entities. So with the responsibility of financial reporting, it lies with those charged with the governance. And considering the current business environment, it is important to for this information to be available so that appropriate decisions can be made, as well as managing the risks that comes with these uncertainties, and to ensure that the financial statements fairly and faithfully present the state of affairs of the entities and provide information that is relevant to users of financial statements. And critical is that this will provide transparent as well as relevant information in these uncertain times, and also the presentation of fair and accurate picture of the company performance, as well as the financial status, which might involve disclosing the future projections and cash flows, especially on areas where there is significant judgment. And also what is important is that once you have an understanding of the risks that are coming from this, you will be able to provide best management judgments as well as estimates in the preparation of financial statements, resulting in the accurate financial reporting that is crucial for decision making. And also with this, you'll be able to have proper controls that will be able to address these risks, and also to be in a position to identify opportunities as well as the threats that are coming from these uncertainties. And it is important to ensure that when you are preparing financial statements, you use the correct basis. And with these uncertainties, it increases the risk of going concern, which is now on the next section, where we are now focusing on the basis of reporting. So with going concern, when you look at these macroeconomic and geopolitical circumstances that are resulting from these uncertainties, management needs to assess whether these events or conditions, either individually or collectively, may cast significant doubt on the entity, significant doubt on the company's ability to continue as a going concern, and in worst cases, whether that going concern assumption is still appropriate. So it is important to have proper disclosures relating to the going concern basis of accounting, as this will assist in achieving the transparency and also provide users of financial statements with the relevant information, especially in the current environment. So management needs to assess the entity's ability of a going concern, and based on the requirements for IS1, a company is no longer a going concern if management intends to liquidate, cease trading, or have no realistic alternative but to do so. So with this, what is important is that management looks at the information that is available and consider possible outcome or events and changes in conditions and realistic possible outcomes that are coming from these uncertain times. So it is important that management identify those events and conditions that may cast doubt on the entity's ability to continue as a going concern, and also to assess the effect these uncertainties have on the operations, as well as the future cash flow. So what is required in terms of the IS10, in terms of the subsequent events, if these conditions deteriorate after the reporting period, the going concern assumption will no longer be appropriate, and based on the IS10, it will be considered as an adjusting event. So where there is these indicators, what management needs to do to ensure that there is proper disclosures that is important to the users. There is need to update the forecast and sensitivity, considering the rate at which these changes under the current circumstances. So if you have prepared a cash flow forecast, you need to continuously monitor and assess if it is still relevant, and adjust as necessary, depending on the change in circumstances and the regular review of those factors that we have highlighted on the Pestel analysis. And with that, you need to be as realistic as possible, and probably also considering the worst case scenario, using the stress testing on those areas. So we have got areas that have got a close call. So with this close call, it's instances where management have concluded that there are no uncertainties related to those events that may cast doubt. And with this, it will be involving significant judgment by management. So what is important is to ensure that the significant judgment relating to going concern is clearly disclosed in the financial statements, and those events and conditions that are not really causing the material uncertainties, they also need to be articulated and disclosed as well in the financial statements. And where there is a material uncertainty, there should be a clear statement that these material uncertainties related to those events and conditions that may also cast doubt on the entity ability to continue as a going concern. And therefore, the fact that the entity may not be in a position to realize its assets or discharge its liabilities in the normal course of business. And where there are no material uncertainties, there is less requirement to do that detailed assessment. However, in these current economic times, we just need to ensure that we regularly visit and monitor the impact of those factors, as some might have an indirect effect and they are difficult to identify. And where going concern basis is appropriate, an alternative base will be required to be used in the preparation of financial statements. I'll hand over to Mike to cover the next section that focuses on the specific areas in the financial statements where these uncertainties are normally prevail. I'll hand over to you, Mike. Thank you.
Thanks so very much, Edwin. So Edwin's now painted the picture for us, and what we're briefly going to look at now is really just how these affect the measurement and recognition of your various elements in your financial statements. And then a couple of slides on, we're going to be looking at what the disclosure requirements are and considerations are in disclosing these uncertainties. So obviously, I think the first and most obvious one when it comes to recognition and measurement is the valuation and the impact of these uncertainties on your valuation of in your financial statement. So the first one would be definitely your asset impairment testing, whether you're doing a discounted cash flows, which rely on future projections. Because of these uncertainties, we just don't always know what's happening and what is going to happen. So the effect thereon on those valuations and preparing those discounted cash flows is very, very important. And likewise, the fair value measures, the assets or financial instruments that are measured at fair value are impacted by these uncertainties. Obviously, higher interest rates, higher risk decreases the value of a lot of our assets, which would have an impact on our balance sheets as well as through our performance. And a big one that we often have a debate with clients, because IAS 12 notes that we can only raise a deferred tax asset if we're going to realize that. If we're going to have taxable profits in the future to realize that asset. So again, if there's a continuous history of losses in the past years because of these uncertainties, because of the environment that we're in, it becomes remote that we'll be raising and recognizing deferred tax assets as well, which again does not bode well for the position of the company. Another one, which is quite a sad one, unfortunately, I think, is with a lot of these uncertainties, there's a lot of businesses going through restructuring or closing or going into liquidation. And what we then need to consider is where certain operations or assets should be classified as held for sale or not, and where those restructurings are impacting that. And we're needing to disclose assets rather in the traditional form, but rather as being classifying those as held for sale or discontinued operations. We need to do so as well, and we're seeing that more and more prevalent. Another one as well, which I think is a common one that people just tend to look over, is the need for when these restructurings are happening, is whether or not there's a requirement to raise a provision for those restructurings. And also a big one, I think Edwin did mention real estate and low occupancies and things like that. With recent times, a lot of people are working from home, but yet have extensive leases, be it for the offices or whatever it might be, whether or not we have any onerous contracts and provisions that we need to raise in relation to those. These are really just some high-level areas that we feel are most significantly impacted by recognition and measurement, but they're by no means exhaustive. So it's just paying attention to these measurements and recognition when preparing your financial statements is rather important. What we're going to move on to now is your financial disclosures. And I think if you attended a webinar that I've done before, I've always said that the disclosures are probably the most important part to think about when putting together your financial statements. And I always say that your financial statements need to paint the picture to the stakeholders, and especially in these times that we're facing now, in these uncertainties, we need to paint the picture, and the only way we can do that is by disclosing what we need to disclose and clearly disclosing what we need to disclose in the financial statements. So just some areas that we need to consider that are impacted quite obviously by these uncertainties. The first one would be your IFRS 7 disclosures. That's the disclosures around your financial instruments and your risk management. Obviously, risk management becomes very important in these times, and those disclosures will be impacted. IAS 36, which is your impairment testing standard, requires us to disclose sensitivity around our impairment testing. So especially those that are cutting close to an impairment or coming close to an impairment of an asset. It is very important that we disclose those sensitivities and that sensitivity analysis in our financial statements. Again, disclosures around discontinued operations or assets held for sale. Also very, very important. Again, whether or not we are or recognizing a deferred tax asset, so when that asset will be realized or not. Edwin did deal with it, but very, very important, especially with changes in interest rates. We were reporting a few months after the actual financial year end, is events after the reporting period. It's very important that we disclose any events that might affect us, whether they are adjusting or non-adjusting, as Edwin went through in our financial statements. And then also, again, unfortunately, there are, as Edwin again mentioned, there's a lot of covenants that are put in loan structures or loan agreements or financing arrangements nowadays, and whether or not those are being breached or not. And with that comes whether or not financial liabilities or specifically should be classified as current or non-current, and whether again assets that aren't going to be are going to be used within the next 12 months should be classified as current as rather than non-current, which puts big pressure on liquidity analysis and things like that on entities. So just painting the picture of what disclosures are required. Very, very important is the disclosure of significant judgments and estimates. We can't emphasize that enough, how important it is to disclose the judgments and estimates that go into financial statements. I think too often we use whatever boilerplate disclosures there might be, or we admit or omit to put something in. I think it's rather important that we disclose these areas and clearly disclose them. Again, just explanations on the assumptions, the risks, the uncertainties that we face in your impairment testing disclosures, your risk management disclosures. It's important to put all of these, your assumptions, your risks, and your uncertainties in. We have mentioned, again, these are your IFRS 7 disclosures, your risk management, your liquidity risk, the potential impact of external factors, be it fuel prices, be it the war, be it climate change, be it whatever, that we're disclosing those and clearly communicating those to our stakeholders. Again, careful consideration when it comes to valuation and impairment, and Edwin did deal quite significantly on quite extensively on going concern. Just reiterating that those disclosures are very, very important to be made. And then again, obviously, on your subsequent events and how that is impacted and how will it affect your reporting and your financial reporting, your figures. It's just so important. I know it sounds like I've said this a few times today, but just transparency is vital in the accuracy and communicating the picture and the financial position of a company to its stakeholders. And the only way we can do that is through disclosures in the financial statement. So that is very, very, very important. So in that, thank you very much. Thank you for your time and your attention. Thank you to Edwin and for the presentation and his section that he dealt with. And hopefully we see you at the next one and enjoy the rest of your day. So thank you everybody.